Spartans! What is your profession?
Howdy traders, Mark Keyworth here, and today we're going to review the options income trades for the week of February the 23rd. One thing to note is once again we have exceeded our target of $1,000 per week, and with 5 trades, so we're just ripping it. More importantly, that year to date, you can see that we've eclipsed the 10K mark. So things are humming right along, and hopefully you're making money with us as we talk about how to put money in your pocket using weekly income. One of the key things we really want to talk about today is this SPX trade, highlighted here. Here we go. So the big thing is how do we choose a short strike in an area of high volatility? So one thing to remember when we talk about how we're going to manage these trades is that we take a look at our max profit, and then our mental stop loss is 2 to 3 times the max profit. So in this case, it's about $900. The idea is we don't want to put a physical stop in place because the market has a tendency to search those stops out, and also if you have a very quick sharp spikes downward or upward, then they'll kind of reach out and knock you out. The market loves nothing more than to search for liquidity, in that manner. So we just keep that mentally. So let's take a look at the SPX. Let's take a look at what is, number one, we have to decide is our direction, i.e. bullish or bearish, and then second of all, where we're going to place that short strike. Okay, here we are in the SPX daily chart. And you can see that we had this, massive, retracement, based upon everyone shorting the VIX. That didn't work out too well. We came back up here, and you can see that we're in this no man's zone between 50 and the 60%, fib retracement area. Now, everyone right now is expecting at this point in time, this to bounce back down off of this resistance area. And especially since you've seen that we have a number of rejections of price above that level. But before we do that, that's kind of what you got to take a look at the market internals. And you take a look at the market internals, one of the first things we're going to look at is what's known as the put-call ratio. You can see here that we have this elevated line at 1, and we got this spike right here at 1, which says that there's an overabundance of puts in the market, meaning that the sentiment is bearish. So that's kind of one data point. You're thinking, okay, now I need to look a little further. One of the other things we take a look at from a sentiment standpoint to see what the market is doing in the bearish piece is the sentiment here on the SPX. And you can see that we came right, to, this point here, and this is right on the date that we're looking at, setting the trade on February the 22nd. We also have a very, broad dip that's suggesting that the market's going to go down, and people are betting against that, or betting for that, and they're buying puts. So if everyone's buying puts, there's nothing more that the market like to do when it's overweighted is to go ahead and put a short squeeze on. And so that means the short squeeze is that they're going to go ahead and run up the stock price. They're going to stop people out. Let's see if we can get this back to you here. Okay, they're going to run, right? They want to run this price up. People have stops here if they're betting short, and that's going to continue on the price action. So that's number one. So the question is, okay, if we think that we're bullish because the market's overweight, being bearish, where do we put the short strike? Well, the first thing we have to look at is what's known as the ATR. You can see here is known as the average true range. And you can see that it is just moving exponentially up due to the increased volatility. And right now, for discussion's sake, it's at 50. Okay, that means that between the absolute high and the absolute low of the day is that they expect the market to move on average 50 points. So if you start off at one level, you could actually drop 50 points, and that's a definite possibility that you have to take into account. So we have to, when you have increased volatility like this, you have to build in, should we say, some additional cushion and not get suckered into the market maker move and what they expect in order to keep from getting stopped out. So let's take a look at what that means. Okay, so now we're looking at an options chain of SPX. You can see that for discussion purposes, it's pretty much trading at 27.80. You see that projection at this point in time for a trade. This is for conceptual purposes. We'll just say, okay, that expires on Wednesday. Today's Monday. And they're saying that it's going to be, basically plus or minus, we'll just call it 25 points. Well, if we take a look at that and we say, all right, we want to, place a trade. We have about an 80% probability. And you can see here that if we choose the 27.50 strike, which is pretty much, 25 points below this 27.80, a little below that, we're at 83% probability. And we come down here and we see that, hey, they're going to give us a credit of 55 cents. Normally this credit is around, plus about 40 cents. This is telling you that the market makers really haven't caught up with the market at this point in time. And a lot of people are saying, hey, look at, I got an 80% chance to make 55 cents, I'll make 40. This is a great deal. I'm going to go ahead and take that trade. Well, we don't want to take that trade here at that level because, given that we have kind of our plus or minus 50, there's a chance that, we're going to drop all the way down to the 27.30 area. So in this case, what we would do, we would look to, move things down to the 27.30 area, and that would give us a 93% chance and really take account for the volatility. So we did the same thing with XPX and the trade that we're putting on, and you can see here that instead of taking, a much higher credit, that we went for like a 93% chance. We didn't take it for 15. We actually set it and got it for 23. But we gave ourselves that extra cushion that's proportion to the volatility and the average true range. Now, this is really, really important because what happened, if we take a look at the actual trading activity, and let's go back to here, and we'll take a look at it here on a 15-minute chart. So let's go ahead and reduce this down. And we come down here and we say, okay, I want to see what it looks like in 15 minutes. And we're going to go ahead and we're going to go ahead and pull the fib lines out, and we're going to move it up just a little bit so we can see a couple different things. And we're going to squish it down some right here. Okay. So the key is that we're placing this trade at mid-morning. Right here we're seeing, okay, kind of an upward move. We already said we want to go bullish. We're seeing an upward bullish piece. Kind of that's measuring our sentiment. But of course, right, after we place this trade, the market starts to come back. And it comes all the way back down, to, 26.97. Let's just call it 2,700. Well, if you did not adjust and had your short strike in that 27.90, 27.95 time frame, that you're going to go ahead and trigger, you're only 10 points away, your P&L is going to show a loss of probably between $2,300 and $2,500, and that's white knuckle time. So you would have got stopped out of this trade. However, since we were all the way down here at 26.75, right, we incorporated the cushion based on the average true range and the volatility, is that when the market took that dip, we were still at minus 700, minus 800, and we did not hit our mental stop loss. That allowed us to stay in the trade, and the next day we had the infamous short squeeze. Boom, we moved up here about almost 40 points, and our options were able to expire worthless. So folks, that's the way you do it. That's how you account for volatility using the short strike. That's the way you look at sentiment in order to choose which is the direction, and that's how you stay profitable. Thanks for your time. Catch you on the flip side.